Welcome to A Course to Retirement with Grand Rapids Certified Financial Planner Ron Corser. Ron Corser and Associates are planning today for the potential of tomorrow.
And welcome into the program. This is your Course to Retirement with Grand Rapids Certified Financial Planner, CFP, President of Ron Corser and Associates. He is Ron Corser. Ron, welcome back in.
Good morning, Peter, and good morning to everybody who's today listening to the program. We're going to talk about one of my favorite things. I love talking about favorite things. I think there's a song there, right? These are some of my favorite things, something like that.
Yeah.
But it's called a Roth
Sound of
IRA.
music.
It's my very favorite account of all time, the Roth IRAs. My wife and I have them. A lot of our clients have them, and more are coming in to say, let's consider creating some tax-free money, because that's in essence what a Roth IRA is. It's a bucket that you paid tax on the money going in already, and it's going to grow tax deferred, and it's going to come out tax-free as long as you kind of go along with a couple IRS rules on how to take money out of it. But it really is simple, and it really makes great sense. Why? We're in a political season, and everybody's losing their mind here in this political season.
Indeed.
And one side's saying, I'm not going to raise your taxes, and the other side's saying, I'm going to raise your taxes. And when people ask me about that, here's my response. I kind of laugh and said, it doesn't matter who we vote for. Taxes are going up over the next 5 and 10 years. Why? Because we have this $25 trillion or whatever deficit it is, and they keep spending more and more money, even though the current tax code is bringing in more tax revenue than any time in the history of our country. Isn't it amazing? We got more money coming in, but we're spending it faster going out. So at some point in time, how's the government, the federal government, the local government, the state government, going to pay for all the things that they're supposedly giving to us free? And that would be, how about the pensions at the state and local level, or even the federal level? How about how are we going to fund Social Security and Medicare? I mean, obviously, no matter what they say in the political season, nobody in their right mind is going to touch Social Security and Medicare. But it's going to cost more. And we're either going to have to pay for it, or some tax work has to come into play. So it's really simple. We down deep inside realize that there's a troll under that bridge, so to speak, saying, he's the tax man, he's just waiting to get you. So the more we can do now to prepare for that time, whether it's 3 years, 5 years, 10 years, the better off we're going to be. And I'll leave this little intro with this nugget. If nothing happens, the tax code will change on the 1st of January, 2025. That's when the tax bill that came into effect in 2018 sunsets. Everything goes back to the way it was then. So the 12% bracket becomes the 15, the 22 becomes the 25, 28. Things are going to get more expensive. And no matter how we look at it, people say, well, I'm not going to have as much income and I won't need to pay the tax. What we don't know,
hopefully we do
with the tax rules.
That's true.
We just don't know that. We're saying, well, the brackets are always going to be there, but I'm going to, instead of making 100,000, I'm only going to live on 60. That really doesn't mean anything in terms of how much tax you're going to pay. And then the other part that we don't talk about a lot because we focus more on income is just think of all the other taxes that are levied on us: sales tax, gas tax, real estate taxes, taxes on taxes. It just keeps going up and up. So it becomes a really big issue as we kind of ease on into retirement, so to speak. What are we going to do about the tax bill? Because it is another expense, and it's going to be one of the major expenses we face getting into the next decade and into retirement in the next decade. So I'm going to be really on top of my game, hopefully, to talk about the Roth, because I think it's a great account.
Well, up until 2025, we have that window of opportunity. And right now we are in a historically low tax environment. So there may be a general window of opportunity right now as well. But certainly with any kind of discussion about finances and financial or retirement planning, you have to include some element of a conversation about taxes into that conversation. And Ron Corser is a certified financial planner. obviously understands that and discusses and addresses taxes with each and every financial recommendation and integrates that tax professional, the CPA, the accountant, where that is necessary and appropriate. But with every recommendation, with every financial move, an understanding of the tax implications and consequences, that's going to be important for your financial future. So today on the program, taking a deep dive into some of the ways that we can create some advantages for ourselves and some control over our tax situation into the future. And if you would like to get more information, if you would like to discuss this individually with a certified financial planner, Ron and his team make their time available for you. All you need to do is pick up the phone and give a call, 616-301-2581. That's 616-301-2581. You can also visit online, roncourser.com, roncourser.com. So on this program, we're going to be discussing IRAs and Roth IRAs. What are they? Why should they be considered? When should they be considered? What are the advantages and disadvantages to each? What are the steps to move between them? How should they be utilized? What money to use? Many more aspects and some certain strategies to take advantage. But Ron, you mentioned the troll bridge there, and it made me think of that old Brothers Grimm fairy tale of the three billy goats gruff that try to cross over the bridge, and the troll's underneath. He wants to eat them, and the way they convince him not to is by saying, essentially, wait till I get fatter. And it's pretty apropos there that most Americans are sort of doing that with their retirement account. The IRS is sitting there waiting under the bridge. Our money has to cross over it at some point in time, but we essentially tell the IRS, why don't you wait until our account gets fatter before you tax it?
Yeah, that's a great analogy. I remember as a little kid reading the Brother Grimm thing, and I always, as a kid, I was afraid of trolls.
Right. Yeah.
I kept picturing a troll as a clown, and I will admit, ladies and gentlemen, clowns scare me to death. I don't see anything funny about them. I think they're scary people. And a long time ago, I saw the movie Chucky, and that just made it even worse. But let's talk about this. Let's talk about the three billy goats gruff. All right. The first billy goat. The troll's under there and he wants to eat him. And the first billy goat says, well, I'm going to do a diversionary tactic. I'm going to throw all my food and money at him as I go try to cross over the bridge, and I'll keep doing that. And he'll be occupied, and then he'll forget about me. So the first billy goat keeps doing that. The problem is that ultimately he runs out of stuff to throw at the troll. He's now stuck. He's probably broke and hungry.
Yep.
So how did that strategy work out?
The
second one says, well, here's what I'd like to do. I'll give you a little bit, and eventually when we cross over, I'm going to be fine. And the troll says, well, that may be a good idea. Just kind of give me a limited amount of what you have, and maybe I'll see what he can do. So it's kind of like paying taxes. He pays a little bit, but ultimately he gets through.
And every time he wants to bring some over, he's got to pay a little bit of it.
Pay a little bit on it.
Yep.
But at least he keeps something, not like the first one.
That's right.
So the third goat, he's a smart guy. He went to college and he's going to do some serious negotiating. And he asked the troll if he can bring it all over to the other side, like the other ones, and pay all the taxes now. But like his second brother, instead of eating it all now, he'll plant some more later. And the troll says, yeah, only good, but you can only do it on a limited amount of time, like he's done with the second goat. So the first goat was constantly making trips back and forth, paying tax on every bit. The second goat had grown himself a huge field just on the other side of the bridge, but did not need to pay tax on any he bought across. It was tax deferred. The third one grew a large field right next to his home and didn't have to travel across the bridge at all in order to eat his favorite grass. He actually paid the tax up front. So I guess it gets down to, which billy goat do we want to be? The one that keeps going over and pays tax all the time and eventually runs out of seed and food. The one who kind of plants the field somewhere within sight, but it's not in reach. And every time he has to get to it, he's got to carve off a piece of it and pay the dues. Or the other guy who just got done with all of it and said, I'm paying all the tax now and I'm going to let it grow tax deferred. Everybody has that decision. There's 3 decisions to make when it comes to how you want to handle your Roth money and your retirement money. Do you want to pay tax every day going across? Doesn't matter. Do you want to pay some tax, let it grow a little fatter, and hope that somehow the government and the IRS relents and blesses you with a smaller tax burden, or you just want to be done with it and control all your money. The choice is there for everybody. I tell people there's probably no wrong choice depending on what your objectives are, but there may be some choices that are a little more right, if I can use that.
Yeah, righter. But Ron, it's a matter of control, really. When you get down to the essence of this question and the three different arrangements that we, the goats, have available to us in crossing that troll bridge with the IRS troll living underneath it, it's simply a matter of control. And we can bring the money across now and bring every bit of money across, but that is going to be taxed as we bring it across. We can leave the money over there in the tax deferred side and only bring it across when we need it, but the rules can change, and the amount that we're bringing over, hopefully is growing, but that's going to be a bigger bill ultimately. Or we can bring some across and then plant it on our side and let it grow there and pay no further tax on it. It seems to me like this is a question that we all need to answer about each and every dollar, but there's some cost benefit analysis that needs to be done. And that's really what you do there for and with your clients at Ron Corser and Associates, correct?
Yeah, we do that a lot. And we work in connection with their tax person, or we can do a little back of the envelope planning. What I want to encourage people to do is to think about, yes, they need to control, but I think it goes a little deeper than that. We all know that rules and regulations change constantly. We know that. We know that for a fact. We know, for example, when 401ks were created back in the late 70s, this was supposed to be the greatest thing since white socks and sliced bread. And the underlying assumption was that you just pack the money into these things as fast and as hard as you can, because it grows tax deferred. And when you retire, you're going to be in a lower tax bracket, so you'll pay less tax. Well, that seemed to make some sense, because looking out across the future, we said, yeah, maybe that's going to happen. The other thing that happened that's really noteworthy is 1997, they created the Roth IRA, which is named after a senator. And why did they do that in 1997? I tell people it's like anything else. If you really want to understand Wall Street and the institutions, follow the money. Always follow the money. So what did that do? They said in 1997, if you want to convert some or all of your IRA money, you can convert it in 1 year and you can defer the taxes over a 4-year period. Why were they doing that? Because they wanted more money.
A windfall, right? A lot of people probably chose to go ahead and pay it, and they received more.
They did. And the markets were going up and Wall Street was generating a lot of tax revenue. Life was good back in the late 90s. We actually had, for 1 year, a budget that was balanced, not because the government was so much better at handling our money, but because they couldn't spend it fast enough. More came in than they could spend. But they did get a handle on that and fix that problem right away. So now we have this.
Fixed it until it was broken again.
They did, yep. Now they need more money. So now we're faced with this situation. One of the things that sometimes I hear people tell me is, well, I don't think I can trust the IRA because they're going to change the rules. Here's how I respond to that. I suppose it's always possible to change the rules. It always is. But I doubt they will do that. Why? There's, in the great scheme of things, there's not that much money in Roth IRA accounts, either in 401k Roths or in privately held Roths. There just isn't that much. The big money, everybody listening to today's program, please listen to this. The big money in America is with the middle class. Depending on who you listen to, there's about $25 trillion held in tax deferred accounts. That's where the big money is. That's where the taxes are going to come. And I'm not, this isn't a political statement, but if you just go back and look at history, every time the government says we're only going to tax the really wealthy, those taxes always come down to
trickle down to the middle class.
They always land on us with both feet.
Yep.
So people say, well, they're going to change the rules. And my response is this: they're not going to change the rules on Roth. Why? Because that will make you crazy angry and you will vote them out of office. And that really is the risk that they take. So they're not going to do it. There's not that much money there. So I think what they may do, possibly, it's just my opinion, because they've done it in some other financial objects before, is they may say, okay, effective this January 1st, nobody can have a Roth anymore.
Kind of sunset it, but
Yeah,
if
just
you've already
sunset it.
got
If you have
money
one, you can
there,
use it, but if you don't have one, you can't. Why?
Right.
Think about this. There's only 3 buckets of money you can have. One is a taxable bucket, where everything happens, gets taxed every year in a dividends, interest, and things like that, capital gains. One is the tax deferred bucket, IRAs, 401ks, 403bs. When you take money out, it gets taxed. So if they eliminate the Roth, which means when you put money in there, it grows tax deferred because you already paid the tax. And when you take it out, it's tax free. If they eliminate that, that means every account you own is going to somehow create tax revenue.
Yeah.
That may be a possibility. So let me give you a little example. And I did this with a client recently. He's going to retire in about 3 years. And this is how we do retirement. We've talked about it. We've said, let's see what happens if Friday is your last day of work. The company comes to you and says, we love you, but we don't love you that much. Have a nice day. We take all of his accounts and we say, can we produce the income he needs in retirement, the retirement income he needs to maintain his lifestyle? And then we say, well, I did with him, say, well, let's say we do it 3 years from now. Now, he had done some incredible planning. He and his wife have a really outsized bunch of Roth money. I mean, I congratulated them. So here's what happened. We created an income plan for him that if he retires this Friday, without taking Social Security, paying, his health care and all those other bills, we got him into an income level where he's going to earn about $60,000 a year in income, which is about what he's spending now. But because we can use some Roth money and not take it all of his IRAs, he's only going to pay about $1,619 in tax on a $60,000 income, because we're able to use Roth money, which doesn't even show up on his tax return. Now, we went 3 years down the road, and we had to make some assumptions because he takes Social Security and some assumptions about tax. We configured it so he'll get a little more money and he's going to have zero tax.
I bet he's excited about that.
He is, because we used the standard deduction for his IRA withdrawals. We made sure his Social Security wasn't going to be taxed, and we compensated everything else with the Roth. That's the power of having a Roth account. That's the power of having Roth money. It gives you control, yes, on how much you spend, but it gives you control on how much you may potentially pay in tax.
Well, Ron, let's talk about a few of the benefits of the Roth. Why consider a Roth IRA? And I think that there are several. Because growth is tax-free within the account. Because income is tax-free when you take the money out. Because inheritance is tax-free when that Roth account transfers to the next generation. Because you can withdraw the initial contributions that you make without penalty even before 59 and a half. So it may make sense for those who are considering retiring early. Since you've paid the tax on the seed, the government does not mind if you take that and remove it and get it back into the taxable cycle. The growth, that's another story. That does have some implications, but there are no RMDs on Roth IRAs, so that's another advantage. You can withdraw all funds, including the growth, at any point in time. Again, the growth has some implications. The withdrawals of growth are subject to a 10% tax penalty. But Ron, 10% is even less than those earning $80,000 or more pay for capital gains. So it's still one of the cheapest ways to grow your money, even with that penalty.
And I think one of the key points that people miss is the last point, how you can access Roth money. So let's go through that because I think it's important.
Absolutely.
Number one, when you put money into a Roth account, you can take that money out the next day. So if you put $6,000 into your Roth account today, you can turn around and take that $6,000 out tomorrow. No harm, no foul, no tax. Because in Roth accounts, your principal or basis or what you put in always comes out first.
And
What
you
you have-
paid tax on it going in.
Right. What you have to leave if you're under 59 and a half is any growth. That will be taxed at that 10% penalty. Now, once you get on a deposit IRA, once you get to be 59 and a half, all rules are off. You have access to all of it, No harm, no foul, no penalty. Now, where does this 59 and a half rule and 5-year rule come into play? It really comes into play with Roth conversions. What is a Roth conversion? That's where you take a portion of your IRA money and you convert it to a Roth and you pay tax this year. So let's say you wanted to do $20,000 out of your IRA and move it into a Roth. That would be $20,000 of taxable income this year. You got to pay tax. Most people will just take the tax right out of the transfer. It's clean, it's simple. Some will, have cash money to do it.
Kind of wash your hands of it at that point in time.
Now, when you do a conversion, there's a separate 5-year clock on each conversion. There's a separate 5-year clock. So that means you put 10,000 in today and you're 35 years old. Well, what are you going to do about the growth? That's subject to a 5-year hold. Even after you're 59 and a half, it's subject to a 5-year hold. But it's just the growth we're dealing with. It's an incredible account. We've had clients that have kept a lot of money for any number of reasons in bank money markets, not paying much. And they have the ability, because of the income levels, to do deposit Roths, to create a Roth account for themselves. And I've told them, why not take $6,000 out of your bank account, create a Roth IRA account for yourself. You can always go back in and get that money. You just got to leave the growth. But it gives you an opportunity to maybe invest in something that might create a little more interest or dividend income for you, or something over and above the 0.2% that a bank money's doing.
And that's another advantage, Ron, because in a IRA, as opposed to even like something that's advantageous like a 401k, with a 401k, we have a set menu of choices and options that our company has determined for us. In any kind of IRA, whether it be traditional or Roth, we have much more discretion and choice of variety over what to invest in, and therefore we can have some inherent advantage there.
You can. Sometimes we use Roth accounts as an offset to the strategies that are available in employer-sponsored 401ks or 403bs. Sometimes it's limited. Some of these 401ks, it's not a secret. They're primarily created to produce growth, if that's possible. And sometimes it's all one big large cap mutual fund, it seems like. So there's ability to diversify your overall portfolio using a Roth account because it gives you access. There's quite a lot of things that can make great sense for people in the investment world other than your basic stock growth mutual fund. I'm not saying they're bad. I'm just saying there are other options out there for people, and they might find it kind of a delightful experience to go and take a look at those. So here's what I'm offering to everybody. Roth accounts are my favorite account. We do them a lot. I understand them. I can help you with them. Give us a call, 616-301-2581, 616-301-2581, or go to our website, www.roncourser.com. You can call us with your questions on Roth if you'd like to set up a Zoom meeting or in-person meeting to just discuss the options. Under no obligation, we do that. It's a passion of mine. It's a passion of people in our firm. We believe fundamentally that we have to try to protect our clients 5 and 10 and 15 years from now from what we believe is going to happen to the tax code and to do our fiduciary best, as we say. This is an important conversation to have. So I encourage everybody, give us a call, 616-301-2581, 616-301-2581. And for you who are going to see this on YouTube or anything, this thing on my neck is going to stay here till the middle of December. And then the doctor said, I'm going to be all right, A-okay, because it was great surgery.
But by that time, some of your yet to be taxed, tax deferred money could be moved over and growing for you tax free.
It absolutely could. And the other good news about this is my uniform usually consists of a dress shirt and tie. Well, obviously I can't wear that right now. So I'm kind of serious casual mode for the next couple months. But it's important to take a look at the Roth. It really is. You know, I'm amazed sometimes when people are afraid because it's been conditioned to minimize and reduce tax today. I get that. I understand it. I'm the same way. Nobody wants to pay one dime more than they legally have to. But at some point in time, if you're going to plan for retirement, it really is important to have somebody like our firm help you take a hard look at the tax question, because it's a big cost in addition to healthcare costs. It's an enormous cost over time. It's been estimated that people who have money in 401ks, somewhere between 35 and 40% of that's going to go to the government taxes over your lifespan.
And in fact, Ron, I've seen the illustrations that you can run that basically extrapolate out certain circumstances. There are assumptions made in there, but where you can show somebody their tax bill if they default to the IRS's plan versus if they are proactive and consider some of the Roth conversion strategies, and the difference is substantial in many cases. It's certainly worth taking a look at. Ladies and gentlemen, if you would like to take a look at your Roth conversion report and analysis, pick up the phone, give Ron Corser and Ron Corser and Associates, certified financial planner, a resource for Grand Rapid area savers and investors, a call. 616-301-2581. That's 616-301-2581. It's a matter of control. The Roth IRAs help us to better control what cannot be controlled. It's us paying our taxes versus tax policy. And while taxes are due once a year, they are paid each and every day, and in retirement, they will be paid on each and every dollar we take from those tax-deferred accounts. We need to take better control over that and realize the opportunity that we have to keep more of our money when it is available. And when we come back, we'll talk a little bit more about Roth IRAs, contributions versus conversions. There's a lot of confusion there. Some people don't understand that they've got the ability to take advantage of this. And Roths are not the only asset class or tax status. Roths are tax status, not an investment, but they are not the only asset class that allows us to build up some of these benefits. We'll talk about a few of those others when we come back here on Your Course to Retirement with certified financial planner Ron Corser. Again, if you'd like to take a look at how to be more efficient and keep more of your money, pick up the phone, give them a call, 616-301-2581. That's 616-301-2581. Quick break. We'll be right back with more of Your Course to Retirement. And we're back here on Your Course to Retirement with Grand Rapids certified financial planner and planning resource, Ron Corser, president and founder of Ron Corser and Associates. If you've got questions, if you've got concerns, if you'd like to address issues in planning for your financial future and retirement stability and security, pick up the phone and give Ron Corser a call. He makes his time available here on the show. He makes his time available for an additional 15-minute conversation just to get the conversation started, 15 minutes on the phone. And if you find out after that time you have more to discuss, he offers the ability for an individual review and evaluation, whether in person or digitally, virtually, through the ease, the convenience, and safety of technology. If you'd like to conduct that, you can carry the conversation further. Pick up the phone to get started, 616-301-2581. That's 616-301-2581. Ron, we are talking about what is likely our largest known expense in retirement, which is taxes, and how to better control that expense. We started off with the story of the Billy Goat's Gruff. You've got another story of a farmer who's meeting the tax man.
Yeah, this is a great one. When they first created Roths back in '97, I didn't make this up. I heard somebody else. I just stole it from them, you know. So I said, and I would do seminars, and I would ask some people, because we're in West Michigan. I said, "How many of you were raised on a farm or are farmers?" And there were always somebody that would raise their hand.
Some hands go up.
Said,
yeah, certainly.
I got a serious question to ask you. If you have to pay tax, is it better to pay tax on the seed before you plant the crop, or on the crop once it's harvested? Now, you should have seen the looks I got from the folks that lived on the farm. They thought, you are a city mouse. You have no idea what you're talking about. But what was the answer? It's always better to pay it on the seed than the harvest. And that is the fundamental basis for considering a Roth IRA account. Now, We're going to talk about contributory Roths versus conversion. There's also a third one, and that's if some people is fortunate enough in their 401k or 403b plan to have a Roth option where you can set aside your employee contributions into that. But let's just focus on contributions and conversions. What are contributions? Contributions are putting brand new dollars into a retirement account called a Roth account. If you're under 50, you can put in $6,000 a year. If you're over 50, you can put in $7,000 a year. What are the income limitations? Because there's always limitations. If you're single and you have adjusted gross income in excess of $139,000, there's a phase out in terms of what you can contribute. If you're a married couple, it starts at $206,000. So for quite a number of people, it's very possible not only to have an employer-sponsored plan at work for you, but to reposition some of your money that may be in a bank or something into a tax-deferred Roth account.
So a little bit of a double opportunity here, Ron. And I think that a lot of people are probably under the assumption that if I have an employer-sponsored plan at work, a 401k, that I'm not allowed to make those IRA contributions. You're saying we can do both?
Yes, you can, as long as you're subject to the income limitation. And there aren't that many couples making $206,000 a year, so it's an option, particularly for people who hold a lot of bank money. Now, because of conversions, those that make over 206,000 are not eliminated from this possibility. They just have to go about it a different way, which I think will conversions have no income limit.
Yeah.
And they have no age limit. You can convert as much of your IRA in any given year as you want. The government would prefer you convert all of it so that they would get more tax revenue. So what does this mean? Number one, let's say you have $200,000 in an IRA. You could this year convert all of it to a Roth. You would pay a pretty stiff price for that, doing it as a lump sum, but you could do it. But a better strategy might be to sit with us and we could work out a conversion strategy that makes sense for you from a tax perspective. Meaning maybe we don't convert all of that 200,000. Maybe we take the next 4 years as a strategy to do 50. Whatever fits your income, wherever you are in the tax implication of it. We can show you in black and white how much a conversion will cost you, because it does cost you in terms of additional tax. That way you can make a decision. If I convert 20,000, I'm going to pay this much money. If I convert 30,000, I'm going to pay this much money. Which one do I want to do? And you can make a great decision on it. So there's contributions, have a limit on how much you can put in and how much you can make in terms of income. Conversions, there's no limit. It's basically a free-for-all. You can do as much as you want to do or as little, but most people do it over time. We prefer to have people do it's a strategy, because this year you may do some, next year something else may happen. You don't know. So maybe you postpone it next year and do the following year. But it gives you some flexibility. The key point is this. Everybody who starts a Roth IRA this year is going to think 5 or 10 years from now, that is the most wonderful account they could ever have created. So if you're interested, give us a call, 616-301-2581. That's 616-301-2581, or go to our website, www.roncourser.com. You can ask a question through that, set up a time to meet either through a Zoom, phone conversation, whatever will help you make a good decision, because that's what we want to do. We want to make sure that you can make great decisions going forward so that you don't wake up one day 5 or 10 years from now and say, oh man, I wish I'd have done this. Oh man, I wish I'd have listened. Oh man, by then it's too late. You don't want to have those experiences.
And unfortunately, a lot of people are waking up to that realization the day after they retire, and they begin creating income for themselves from those tax-deferred retirement accounts. Again, being proactive, always beneficial here. Ron Courser and his team can help you crunch the numbers, put it in black and white for you, show you the costs, benefit analysis, and make sure that you are making a well thought through and informed decision. And if you would like to see that, if you would like to identify some strategies to maybe leverage your dollars and keep more of them, pick up the phone and give a call, 616-301-2581, 616-301-2581. 2581. And Ron, you have a list here of about a dozen different strategies for conversions. But again, just to differentiate, contributions is putting brand new money into a retirement account. And the limitations with IRAs are $6,000 per year if we're under 50, $7,000 per year if we're over 50. So not a real generous amount limitation wise. That's not going to get us a real lavish retirement lifestyle. Even if we started at 20 and did that all the way until 60 years old, that's just not enough money to retire off of. And we're limited by how much we make. If we're a single filer, we can't make more than $139,000. If we're married, $206,000. So some real limitations on contributions. And that's why some of these conversion strategies are probably something that we need to more and more seriously consider.
Yeah, no matter how you do it, the objective is to create tax-free money. You can do a little bit of conversion, a little bit of contribution. You have a lot of options available to you. The simplest option for people that are still working and maybe 20 years away from retirement or 10, the simplest option is if you have a 401k Roth option with your 401k plan, that is the simplest option to do. Because that Roth money is really tied into how much you can defer in a 401k plan. So think about this. If you have that option, take advantage of it. Yes, you'll pay a little more tax on what you defer. My response to that is, well, 5 years from now, what if you were paying a total of 20%? That's how much you're saving in tax because of your income. So everything you defer into a tax deferred bucket, you save 20 cents on the dollar. Now, what happens if 5 or 10 years from now, tax rates change, codes change, and they charge you 30 cents or 30% to take that money out? Here's a question. Would that have been a good deal?
Yes.
You save 20 going in, it costs you 30 going out.
Well, especially, Ron, I don't mean to interrupt here, but especially considering that the primary objective with all our money is growth on it. So if today we're paying that 20 cents on the dollar on $10,000 and our objective is to grow that money 5 years from now, that might be $20,000 or $30,000, or hopefully it would be. Yeah. But now we're paying potentially more on an even larger pool of assets.
Yeah, the tax bill doesn't ever go down unless you die or you run out of money. The tax bill always there.
Just a realization, Ron, that I had. That is actually one area where our interests and the interests of the IRS are actually aligned. They want our tax deferred accounts to grow in value.
They do, and they want the last dollar out of it too.
Yeah.
So anything we can do to postpone that is a good idea. So let's take a look at some of the things that we might do. Ideas. So I'm going to kind of do hand shadows over the radio program here. One of it is to maximize the bracket. What do I mean by that? Let's say you're in the 12% bracket and you have taxable income as a single person or a family of $60,000 after deductions and everything, AGI. AGI is 60. Well, you have a lot of room in that 12% bracket to go up to the maximum. What that means is that you can potentially convert what the difference between your income, taxable income, and the next highest bracket. You can convert that portion. It's not going to change the bracket. You're just going to pay whatever real tax rate you're paying in that particular bracket. So that makes it easy. So it's important to understand brackets. We do a lot of kind of explanatory work with clients to help them understand it because it's part of making a good decision. So you get it under the next highest bracket if you can do that. On the other hand, if you're just over the next highest bracket, if you go from the 12 to 22, you're already into 22. And if you have positive hope for the future and you're going to be employed, making good money, it still makes sense. Because remember, if you're in the 22% bracket, that doesn't mean all your money gets taxed at 22%.
Right. We got that progressive tax system.
It's a progressive tax. Now, those extra dollars will be, but your overall tax rate will not be 22%. It'll be something lower. So that's one of the things to think about is where you are in terms of the brackets in your taxable income and what kind of maneuverability do you have?
Well, Ron, if I'm not mistaken, when you cross the threshold from the 22% bracket, the next threshold currently is the 24% bracket. But as you were saying at the beginning of the program, the current tax laws that we have in place are set to sunset in 2025. And at that point in time, the 22% bracket becomes the 25% bracket anyway. We may be paying higher just by default.
You will. That's a great point. Just by default. If you don't do anything, I promise you're going to pay more in tax. Boy, that's a terrible thing to say on a radio program when you're trying to
Which is exactly counter of what we have been told as we were saving those dollars.
Yeah.
That if we didn't do anything, that if we saved them over here on the other side of that troll bridge, that later down the road we would pay less in tax. And for those that took that advice in the 80s and 90s compared to today, Ron, that may be true. But today, looking forward, that's a completely different scenario, which is why we need to carefully consider these Roth conversion strategies. And again, if you'd like to see a cost-benefit analysis, if you'd like to see in black and white and red and green, where exactly there is a cost and what it would mean for you into the future for how much you could ultimately save in taxes, pick up the phone and give certified financial planner Ron Corser a call, 616-301-2581, 616-301-2581. Because Ron, a lot of people have built up a sizable amount in those tax deferred buckets, those 401ks, those IRAs. A contribution is putting new dollars into any kind of retirement account. We talked about the limitations there. But a conversion involves proactively reclassifying existing retirement dollars, potentially these tax postponed, tax deferred dollars. And the benefit is that we can control that tax bill. We can let those now grow tax free. The downside is that there will be a tax to be paid on that conversion. But again, that's where the rubber meets the road in the report and the analysis that you can run and help people better understand that cost.
Yeah, it gets back to the seed and the harvest, doesn't it? You know, you're going to pay money on the seed, you're going to pay it on the harvest. The IRS wants to do the harvest. Most rational people want to do the seed. And then there's a little bit in between. So it's important to take a look at all that. I was just listening. I thought, don't you get the feeling sometimes that the IRS speaks with forked tongue?
Well, when Albert Einstein said that the most powerful force on the planet was the power of compounding interest, I think that the IRS was paying attention.
Yeah, they were. Yeah, they were. They make all the rules, and they're not necessarily a malevolent force, but they're not that friendly to what we have to do. So that's one idea, thinking about that. Let's talk about another one. Now, I'm going to talk about my mom for a minute. I miss her dearly. My mom, her idea of a great tax return is that she got money back. That's all she cared about, did you get money back? And a lot of people are like that. How are the taxes? Well, I got money back. And yes, you can explain how that all came about, but it always was getting money back from the taxes. So here's an idea. For those of you out there who are used to getting money back when you do your tax return, that's real money that you really haven't spent, isn't it? You've just kind of loaned it to the government for 365 days, and they give it back to you without paying interest. Why not consider taking a portion or all of that refund and dumping it into an IRA, a Roth IRA? I mean, it's pretty painless if you think about it. You haven't used the money, you've just given it to the government. Every year you keep giving them money so that they can do whatever they do. Why not take some of that money instead and put it in your own private bucket called a Roth IRA as a deposit, as long as you have the income limitation covered? Makes great sense.
Or Ron, if you don't, using that money to pay for the conversion. Because again, if we've got money over here in this tax deferred bucket, let's say it's $10,000 and we receive a $2,000 refund, we could essentially just offset the cost of converting that full $10,000.
Yeah, the refund is nothing more than a checking account the IRS has with you. And they
0.00% interest.
And they just take your money and use it, and then they give it back to you once a year, and then they collect it again. So that's a pretty good use of the money. I know some people look forward to that to live on it. I get that. That's a forced savings program. I'm not telling you, if that's where you are, that you should change what you're doing. But if this refund keeps coming and you don't have any use for it, maybe you ought to do that. Here's another one. This is one that I kind of like. sometimes people say, well, I'm contributing to my 401k and there is a Roth in it. And my response is, well, how much are you putting in? Well, I'm putting in to get the match. Now, the match always goes into the tax deferred one. So I say, well, how much is that? And they might say, well, I'm putting in 7 and I'm getting 3 or something like that. And then I ask them a really sincere question. Is it possible for you to save more in the 401k Roth account? Can you defer more than 7%? Can you move it up to 8 or 9 or 10? I'm not talking about doubling it, but can you add a little more? What an easy way, what a really easy way to continue to save on a tax-free basis down the road. So sometimes we overlook it. We say, well, I'm just going to get the match. That's all I'm going to put in. But we also should ask the question, and I do, is it possible to do just a little more? Because just a little more makes a lot of difference.
Or
over the
Ron,
next 10 years.
What about if they are doing 10% contributions and 5 of it is going to the traditional tax deferred side and 5 of it is going to Roth, maybe shifting that and pushing a few more of those percentages over to the Roth wouldn't even make that big of a difference in your bottom line. Yes, you'd have to pay tax on a little more money now, but it could make a huge difference in the end result in retirement, given some time and some growth.
Yeah, that's a great point. We've actually seen that, and people have changed. They've just gotten rid of the tax deferred bucket and just said, I'm going 100% into the tax-free bucket because I do buy into the idea that 10 years from now, it's going to be interesting when it comes to taxes.
But Ron, it sounds like definitely feel that the potential for having the ability for Roth contributions at work inside the 401k is beneficial and should strongly be considered.
It is. And if you have that option, that should be the number one option from my point of view. Don't create a separate account. If that's the only option that's feasible for you and you have it, do it. Do it in a 401k plan. You're going to be incredibly blessed down the road.
And if I'm not mistaken, Ron, because it's offered to the employees at an employer, if it's offered to one, it's got to kind of be offered to all of them. And therefore, some of those income limitations don't apply. If you've got a Roth 401k, it doesn't matter if you make more than that $206,000 as a married couple, correct?
No, it doesn't. It doesn't. And sometimes that's the only option with higher income people. If they have that, that's the option. That's the only option. It's the one they must do. And they're very good with that. They do it. Yeah. So let's keep going. Let's talk about contributing. Well, we talked about contributing over the match, but let's talk about what are the disadvantages of Roths. Everything's not perfect. I know that may surprise people listening. This is not a perfect account. It comes as close as you can get, but it's not perfect. So what are some of the downsides that you potentially have to be aware of? Number one, and this does with 401k Roths and conversions because it creates more taxable income. If you're within, say, 3 years of retiring and going into Medicare, one of the calculations that we do with clients, and every advisor should do with their client, if they're thinking about adding more to the Roth account, either through the 401k employee part or through a Roth conversion, you have to be aware of the Medicare Part B income limitations. It may not impact you, but Part B on Medicare, when you get to be 65, it costs you money. They take it out of your Social Security payment. And the more money you make, the more they take out. Depends on the tiers. So you have to work with an advisor who, number one, understands that, and number two, who can bring that information to you so that you can make a more informed decision. So here's what happens. Let's say you're 3 years from retirement, and in the third year, you convert $200,000 of IRA money. It's all taxable. Your income just, boom, went up to the 24% bracket maybe, or higher. Well, you're okay at the third year. Where the problem comes in is if you do it in the second year, because Medicare goes back 2 years to look at your income to determine how much you're going to pay the Part B premium. So it's a consideration. So you may want to say, because you're a highly compensated person, that if we're going to do the converting, we do it up to the third year before retirement, and then maybe we don't do any more. We may do something else that'll help. But it's a really important thing because sometimes people can get really backsided and say, wow, my premium on this thing is incredible. Yeah, that's because you had all that money coming in before. So it's another part of the conversion process, the IRA process, the whole strategy that we do with clients. So if you're interested in some of these, they sound like little nits, but man, they're big nits if they come to play. Give us a call at 616-301-2581, 616-301-2581. Be more than happy to chat with you on the phone, do a Zoom meeting, have a phone conversation, or in person. We're fully stocked up here, and we're pretty antiseptic in our office, working off site and inducing the distancing, and you have to wear a mask to come in and see us. But go to the website too, www.roncourser.com. Ask us your questions. Be more than happy to help you. Our job is to help people. To help people, because I think what's coming down the road, I don't know exactly what it's going to be, but I think it's going to be really interesting. And the more we prepare today for that, the better off we're going to be.
Well,
it would be nice to see.
I want to make one point, Ron, that you actually have a Medicare specialist in your office there. Your wife, Nancy, really focuses on that area, helps people through that process of the enrollment, making sure that they're making well thought through and informed decisions. And you, as the CFP, with that forward-looking proactive approach, can identify that in a few years, you're going to be making some decisions here with Medicare and probably should not make or should make some considerations of these Roth conversions, but with that combined comprehensive look, taking a look at it from both angles, understanding what the consequences and repercussions might be. And
yeah, we made a decision a long time ago to include the healthcare part in our planning process because it's such an enormous piece of the retirement plan. It seems silly to say, well, we only do investments, you go somewhere else. No, we can do it holistically. We can do the healthcare planning and the investment planning, the Roth planning and all that together so that you get the absolute best set of circumstances and facts in front of you to make a really great decision for yourself.
Well,
so a couple other things to think about with Roths. Number one, the RMD issue got pushed into the age 72. I guess that's okay. It just means that they're going to, for those of you who are running into 72 this year, or next year, they're going to take out a bigger percentage to start with. And keep in mind, the RMDs always keep going up. So here's a little nugget. Think about this. If you can take your tax deferred money in the IRA and you can peel it away now and start to reduce that IRA by converting it to a Roth, when you do have to RMD, there's a smaller number that it'll be based on. So your taxable income on a required minimum distribution will be that much smaller. So part of this planning process also says, look, you're 67, you obviously don't need an RMD, but maybe it makes sense to start peeling away some of that IRA money into a Roth with a conversion so that when it does come RMD time, the base is smaller. Because remember how RMDs work. They value your IRA on the 31st of December, and that's the percentage they attach to that number. So it's just another little thing to work at. Here's another little idea you might think about. Nobody likes to get into a market that corrects. I have never met anybody that said, oh, I love market corrections. You never do that. But you can make even bad things work to your advantage. We did that this year. When the market went down 31% in March in 21 days, some people lost some money. We used that opportunity to convert Roth money. We used that opportunity to move maybe a little less or a little more, but to move some of that over. And what's the benefit? Now in the Roth accounts this year, because the market has come back so sharply, they've made money in the Roth account. So it makes some sense sometimes in a downturn to say, all right, can I make a cookie out of this pile of mud? And the fact is you can take advantage of it. So that's another thing to be, it's like one of those opportunities that just says, let's go for it.
Well, Ron, you stated that you didn't know what the future holds and that there is uncertainty. But the conversation of today is really about taking what we cannot control, potential changes to tax policy, and bringing it within our control with our tax planning. And you've got a lot of notes here on strategies for the income eliminated, strategies for new contributions, strategies for conversions, tax planning versus tax preparation, the future of taxation versus our taxes. And you've got a lot of math that we just simply are not going to have time to get to on today's program. So if you don't mind, let's continue this conversation. Let's carry it forward and carry it over and continue the conversation about Roths, about Roth conversion strategies, and about better controlling that tax bill into and through retirement. And let's get some specific strategies and discuss those in depth in the weeks to come here on your course to retirement, because this ultimately is going to be important for anybody that's got a dollar saved in a tax deferred account, an IRA or a 401k, a 403b, something that they will create income from in retirement. This conversation is going to be vitally important. And again, ladies and gentlemen, Ron Corser, a certified financial planner, and his team can help run a report and analysis, show you where the rubber will meet the road and what your tax bill will be, and then help you strategize to minimize that and keep more of your money. If you'd like to take advantage of that opportunity, pick up the phone now, give a call, 616-301-2581, 616-301-2581, 616-301-2581. But Ron, time moves by very quickly here on the program, as it does in life. You've said that we've got a window of opportunity really right now where taxes are on sale that might be an ideal time to consider some of these conversions. Let's not let opportunity pass us by. What do you say we continue our conversation?
Yeah, we'll do that. I look forward to it again because there's a lot more. You know what I tell people? You can go to the bank and with about 2 pieces of paper create a Roth IRA. Then when you go to the IRS tax code, there's about a 600-page booklet that talks about all the different kind of restrictions on IRAs, how to take money out and all that stuff. So going in is kind of easy if you make up your mind with a good strategy. It's the coming out part that we need a lot of work on. So be more than happy to help you with that. Next week, we'll talk more about the Roth. Tune in, take good notes, have a blessed weekend, and we'll see you soon.
We'll talk to you next time on your course to retirement. Ron Corser, looking forward to hearing from you, helping you, assisting in any way he can. 616-301-2581, 616-301-2581. Ron, take care. We appreciate the time. We'll talk to you next week.
Thank you, Peter.
Tune in to Ron Corser's full radio program, A Course to Retirement, Sunday mornings at 9 a.m. on WOOD, and visit roncorser.com for many valuable resources, including other great episodes of Your Course to Retirement.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.